The big, beautiful bill has passed. And there's a lot in this. And so now that we know exactly what's going through, we're going to talk about it and how that can affect you guys. So first off, there's a lot of highlights here that will impact a lot of the tax planning that we've been doing for a lot of our retirees. And while there can be many arguments made on the amount of debt that might be added because of the bill. The point of what we're going over today is not to be political, but rather just open eyes to opportunities that are available out there right now. And so first off, let's start with the marginal tax brackets. They're remaining where they're at, and they're being made permanent. So we've got 10, 12, 22, 24, 32, 35, and 37%. So the highest is 37, the lowest is 10. Technically, the lowest is zero, actually, if you've got your deductions and credits and stuff like that. And so they're made permanent, at least until a future Congress votes to change the tax code again. But that does create an extended opportunity past 2026 now for some tax efficient planning moving forward. And in addition to the permanency of the marginal tax rates, the bill also made the standard deduction permanent and increased the amounts again until a future Congress changes those too. And so just to give you an idea of what those are, and they will be adjusted for inflation in the future as well. Right now in 2025, a single filer is $15,750. The married is $31,500. And in addition to the standard deduction, this is going to be big news for basically all of my clients since I work with retirees. Anyone who is 65 and older will receive an additional $6,000 if you're single, $12,000 married filing joint. So basically another $6,000 deduction on top of whatever deduction you're already receiving. And so what that means, if you are a single filer, and you're over 65, instead of a $15,750 standard deduction, you've got a $21,750 deduction. And instead of $31,500 for married, you have $43,500 for married filing jointly if you are both over 65 years old. And so that means that's literally $43,500 before you're really paying any tax on any money that you have. And one of the reasons, and there's also some phase outs in this as well. So I do have to mention that because this is going to be very, very important when it comes to any of the tax planning that's done, especially Roth conversions. And so the $6,000 will be reduced by 6%, by which your amount exceeds $75,000 for the single filer, $150,000 for the married filing joint. And so what that was is an attempt to have no tax on Social Security. So they weren't actually able to get the no tax on Social Security into the bill to get it passed. And so what this is trying to do is to help lower the amount of tax that they're all paying on Social Security. So that's where that lays. And that also means, so if you think about it, so 75,000 or 150,000, that extra deduction starts to phase out. On the surface, what that could mean is if you are married filing jointly and you get that extra $12,000 deduction, well, technically that could mean if you're doing Roth conversions, like if you're part of our clientele that we've decided that that is going to be a benefit for you tax-wise and also benefit your kids as well, then that basically means we have another $12,000 per year to be able to do that. However, if we hit those phase outs, again, 75,000 for single, 150,000 for married filing joint, well, then we start to reduce that $12,000 deduction or the $6,000 deduction. So it may not actually give us the $12,000 if we start getting phased out by doing those Roth conversions. So basically what that means is we're going to be relying heavily on our tax software in order to make sure that these moves are still beneficial, and there could be some cases where it doesn't make sense to go over that $150,000 over these next few years. There could be other cases where it does make sense to go over those and actually phase out, because the amount of taxes that we might save long run are going to overshadow the extra $12,000 that we miss out on by phasing ourselves out. So again, we're going to have to be relying heavily on our tax software still to find out whether or not those moves are beneficial and up to what point. So sticking with deductions here for a little bit, there's also a $10,000 deduction for car loan interest, but there's a couple of catches, a couple caveats there. Again, there's a phase out starting at $100,000 of income for single filers and $200,000 for married filing joint. It'll be reduced $200 for each $1,000 over those limits. And the final assembly of the car has to be here in the US. And so if you're sitting here like I am with a Subaru at this point, that's not going to cut it. And so this is making me go, you know what? I didn't really like that car right now anyway. Maybe I should go out and buy an American made one right now and start deducting the interest off of that. You know, maybe. Again, I'd have to run the numbers on that. Charitable giving. So here's a pretty cool thing. First, the change did create a 0.5% floor to adjusted gross income. So what that means is you've got to hit that 0.5% floor before it starts to become deductible. And that does create an opportunity for those that are charitably inclined to maximize some tax planning in combination with charitable giving, because for even those who don't itemize now, they are putting back in that above the line deduction that they used to have a few years ago. And it's more than just a couple $100 this time. It's actually $1,000 per person. So if you are married filing joint, you can actually deduct up to $2,000 before your taxable income, before all of that is figured out, before it's above the line, above the AGI. And so that's even without itemizing. You can get $2,000 deduction even without itemizing if you are charitably inclined. So I've got several of my clients that donate way more than that every single year. And so they can at least get to 2,000 on the front. And then most of them are doing qualified charitable deductions if they're able to, if they're old enough to be able to utilize the qualified charitable deductions, because they have to take their RMDs, the required minimum distribution. So basically, if they're 72, 73, or 75 at this point, and they're taking those required minimum distributions, we can lower the amount of taxable income from those required distributions by sending the money directly from the investment company to the charity. And so that means that we could do $2,000 above the line and then do a QCD for the remainder of whatever they're contributing. But I also do have a lot of clients that, you know what, a few $100 is what they donate, or a couple thousand is what they donate. So for those, this is going to be perfect, because now they're going to be able to deduct those without having to do any crazy QCD or, whatever type of moves, tax, flips, machinations that we want to do. They can just write it right off at the above the line deduction. So that's actually pretty cool. I like that. Getting back to giving tax breaks for those that are giving to charities. Also, they have increased the estate planning deduction. So, or estate tax limit. We've got $15 million in 2025 if you're single, and $30 million if you're married filing joint, and it will be adjusted for inflation above that. So right now the estate tax exemption is 13.99. So it's super high already. So this didn't really increase it a whole lot, but it is increased a little bit. There you go. So what that means is if you're single and you don't have $15 million yet, you don't have to worry about this. If you're married, you don't have $30 million in your estate, you don't have to worry about this, because only the amount above those numbers when you have to start paying estate tax. So if you're married and you have $31 million in your estate, well, then you'll owe that estate tax on that extra $1 million. So that's how all that works. Bonus depreciation is back as well. Let's see here. You could also, if you're building like a factory or something like that, you can actually expense 100% of it in the first year. Usually those things are depreciated over decades. And now they can actually get a bonus depreciation in the first year. And they've got to be put in place after January 19th of 2025. So it can't be ones that have already been bought. It has to be ones that have been put in place basically late January of this year on. And that could work out really well for a lot of those companies that have pledged to build factories here in America. Even some car companies that have decided, because of all of the tariffs, to build factories here in America to avoid those tariffs. Honda, Hyundai are a couple of them there. Some semiconductor factories as well. So over the next decade, there have been basically trillions of dollars that have been pledged to be invested into building factories here in America. And this could actually help. Basically, I'm going to say put all of that up in those deductions in the first year. So that actually allows bigger investments that can happen quicker in those places because they get a bigger tax deduction up front, allowing them to be able to deploy more capital because they don't have to pay as much tax. So I think that's really good for job creation. So that's a good thing. Unfortunately, the new and used EV credits are going away after September 30th. So if you're thinking of buying a Tesla or any of the other electric cars that are out there, those credits are done after September of this year. So if you are going to get them, you might have to buy it before September. So we got a little over a month there. Um, it also created the temporary no tax on tips. So that's not a permanent thing. That's basically running from 2025 to through 2028. And that means up to $25,000 can be deducted. And again, that's an above the line deduction. So you don't have to itemize to get that. It's just basically just right off the top. There is a phase out. It's going to be reduced by $100 for every $1,000 if your income exceeds over $150,000 if you're single, and $300,000 if you're married filing joint. So it's pretty high up there. And so if you're in a service business and you're getting taxed on your tips, you can at least get 25,000 of them tax free, even if you make quite a bit of money. And so above the line deduction, man. So that means even if you're taking the standard deduction, you still get this. And for overtime, the deduction is up to 12,500 with the same income phase outs. And so no tax on overtime, not quite as attractive as the no tax on tips, but hey, every little bit helps. $12,500 that you can get now tax free because of that. There you go. There's also something that I think kind of snuck in there that nobody really talked about. And honestly, it doesn't even kick in until 2027. So we don't really have to worry about it for at least another couple of years. But there is a $1,700 credit for any donations to scholarship granting organizations. And so what does that mean? $1,700 credit means if you give up to $1,700 to any organization that gives out scholarships, you get a $1,700 credit. And a credit is a dollar for dollar reduction on your taxes. So you give $1,700, you get $1,700 back. So basically doing this literally costs nothing in 2027. So it starts in 2027. So if any of you guys out there would like to do that, then just start trying to think of what organizations you're going to look for, what scholarships are given for what, and find something that's on your heart. Give the $1,700, get it back at tax time. It literally costs us nothing to do this, and so that is if you actually will have more than $1,700 of tax liability after all of your deductions. So again, software. Don't just go out and do it if you're not going to have any actual tax liability, or you don't have $1,700 of tax liability because of your deductions, your credits, and your income levels, or whatever it is. Then no, you won't get that back. But as long as you're going to have at least more than $1,700 of tax liability, this will make sense, and you'll get it right back. And finally, the SALT cap. So for those of you that aren't familiar with the acronym SALT, it's state and local tax. So if you're in an area that has a state income tax or even a local income tax, we have, if you itemize, you've got the ability to deduct what you pay in state and local taxes. In the past few years, that's been limited to $10,000. So not a very high deduction. Matter of fact, I've been capped out on that for several years. Well, now they're raising it to $40,000, and it'll continue to increase by 1% through 2029. And in 2030, it'll revert back to the $10,000 if another bill or whatever doesn't go through. And so the upper threshold there is $500,000 for both single and married filing joint. So quite a huge threshold to hit in order to start phasing out on that one. Now, while this doesn't encompass everything in the big beautiful bill, it does contain a pretty high level one of the ones that I feel are most likely to impact the average retiree and average family. Well, I guess if you're a family but not a retiree yet, you still got kids, they have increased the child tax credit as well. And so there's good news there. I've got a couple kids, so that's actually going to affect me. So that's great. I like that. Also, if you've got any other questions, we've got a white paper called Unlock Your Tax Savings. It's how the new tax laws may open up opportunities for retirement and estate planning strategies. And so basically, if you end up clicking on the link here, I believe putting in your email address, you should be able to get that downloaded and be able to get that for you. So There you go. Get a white paper, unlock your savings. So if there's anything else that's a little bit more nuanced that I didn't go through here that covers, then for those of you that love to read, and I do too, it kind of just makes the information stick a little bit more than just listening to it audibly. So go ahead and grab that. And if you have any questions out there as well, or if you would like to actually take advantage of some of the things that we can do from this tax standpoint, reach out to us as well. There should be a link for a 15-minute consultation, a 15-minute phone consultation, just to see if there's anything that we can help with the concerns about retirement that you have, because we're always trying to bring information to you to empower you to live the retirement you deserve. That's it. Thank you very much. And we'll be back with maybe hopefully something different than the big, beautiful bill next time, because I feel like we've been on this topic for a little while. But thank you so much, everybody, and have a great week.